In 10 days, Donald Trump is scheduled to board Air Force One for Beijing. The meeting with Xi Jinping is set for May 14th and 15th. While the White House frames it as a trade reset, Beijing describes the encounter as ushering in a new era. Yet beneath the surface, both sides are keeping critical details quiet. China has recently passed sweeping trade rules that alarm every U.S. business operating within its borders. Coinciding with the announcement of this diplomatic summit, these regulations carry significant implications hidden in the legal fine print. Among these, 3 clauses stand out as directly impacting the financial stakes for Americans everywhere. If you haven't yet reviewed China's Decrees 834 and 835, they were signed into law on April 7th and April 13th, 2026, and became effective immediately with no transition period. These legal changes could prove to be the most consequential developments surrounding this summit. To understand the backdrop, consider the power dynamics at play. The popular narrative of a balanced negotiation between two equals doesn't match the actual data. Trump's visit marks the first time in nearly a decade that a U.S. president sets foot on Chinese soil, the last being Trump himself in 2017, after which the U.S. launched a trade war. China has not forgotten. Over the past year, Xi Jinping has been methodically accumulating leverage to shape this precise moment. The bilateral relationship involves nearly $600 billion in annual trade, with American firms investing over $250 billion directly in China. Beijing has spent the last 18 months identifying every weak point and transforming it into strategic leverage. The Busan meeting in October 2025 demonstrated the effectiveness of this strategy. China temporarily eased restrictions on rare earth exports, committed to buying 25 million metric tons of American soybeans annually through 2028, and made pledges on fentanyl. In return, the U.S. lowered tariffs and indicated potential loosening on NVIDIA chip sales. Analysts at Piper Sandler noted the clear advantage for China, a sentiment echoed by Wolf researchers Tobin Marcus, who explained how rare earth controls and soybean embargoes compelled Washington to ease tariffs. This establishes the baseline as Trump approaches Beijing. Clause 1, however, changes the rules entirely. On April 7th, 2026, China's State Council issued Decree 834, concerning industrial and supply chain security, effective immediately. Unlike any previous Chinese law, this decree elevates supply chain decisions by foreign firms to matters of national security. Practically, any U.S. company performing ESG audits, supply chain due diligence, or forced labor compliance checks in accordance with U.S. law may now be interpreted as violating Chinese national security. Article 13 explicitly forbids collecting supply chain information within China that conflicts with state provisions. The language is intentionally vague, granting regulators broad discretion. Every American multinational, Apple, General Motors, Boeing, and retailers with Chinese suppliers, now faces a legal framework where following U.S. regulations could simultaneously breach Chinese law. This is no longer theoretical. It is the legal reality as of April 7, 2026. Clause 2 escalates the risk, introducing personal criminal liability. On April 13, 2026, just 6 days after Decree 834, China's premier issued Decree 835 on countering foreign improper extraterritorial jurisdiction, also effective immediately. This decree formalizes what lawyers call the malicious entity list, a designation far more severe than the existing entity list. Firms or individuals placed on this list encounter frozen assets, travel bans, revocation of work and residency permits, blocked transactions with Chinese entities, and strict limits on data transfers. Most importantly, Article 12 extends potential criminal liability to individuals, not only corporate entities. American executives and managers working in China for U.S. multinationals now face personal legal risk if their companies comply with U.S. sanctions, export controls, or sever ties with Chinese partners as required by American law. China's enforcement of its UEL expanded from 3 designations in 2024 to 67 in 2025. And Decree 835 gives this machinery criminal force. This legal shift connects directly to the Beijing summit. What is at stake is not abstract. It is a tangible financial and legal risk for every American involved in China. Compliance with U.S. law could simultaneously place executives and employees in peril under Chinese regulations. The summit, public handshakes, and diplomatic language may hide a far more complex legal and strategic battleground. China dominates roughly 60% of global rare earth mining and controls nearly 90% of the world's processing capacity. Every semiconductor, electric vehicle battery, missile guidance system, and AI chip powering data centers that support the American economy depends on materials processed in China. In October 2025, Beijing made clear it would wield that control strategically, imposing broad export restrictions on rare earths, gallium, germanium, antimony, and graphite, sending immediate shockwaves through every U.S. defense contractor and technology firm. The United States responded by lowering tariffs. In effect, Washington blinked. The resulting Bususan deal was presented as a one-year pause, a general license permitting exports of these critical materials. The key term is general license. Supply chain compliance experts warn that such a license can be revoked at any moment. Today's relief may disappear tomorrow. Beijing structured the agreement to retain maximum flexibility for itself while extracting concrete concessions from Washington. Now, Trump heads to Beijing to negotiate the next phase, carrying a trade deficit exceeding $270 billion, a technology sector deeply reliant on Chinese processed materials, and two recently enacted Chinese laws placing all American firms in China on formal legal notice. The financial baseline shaping the leverage at this summit is clear. The U.S. trade deficit with China reached $295 billion in 2024, the largest bilateral shortfall the United States has with any country globally. U.S. farmers rely on Chinese soybean purchases, which account for roughly 60% of total U.S. soybean exports when Chinese demand is at full capacity. American technology companies are equally exposed. Apple generates about 20% of its worldwide revenue from China, while Boeing holds outstanding orders from Chinese airlines worth tens of billions of dollars, orders that Beijing has intentionally delayed to apply pressure. Xi Jinping approaches negotiations fully aware of which levers inflict the greatest political pain in the United States. Soybean price fluctuations hit rural states Trump must win. Boeing-related job losses affect swing state manufacturing communities. Apple stock volatility impacts retirement portfolios nationwide. Beijing has mapped U.S. political geography with precision and embedded it into its trade strategy. The third clause carries the most immediate personal financial consequences after May 14th. It concerns semiconductors and what Trump might need to concede to secure a permanent rare earth arrangement. NVIDIA represents the most pivotal factor in these talks, linking your investment portfolio to America's long-term technological competitiveness. During the Bususan summit, Trump indicated that Washington would act as an intermediary between Chinese officials and NVIDIA, signaling a possible easing of semiconductor export restrictions. Beijing's explicit goal heading into the Beijing summit is gaining access to advanced AI chips. China's 15th five-year plan, finalized just days before the Bususan meeting, emphasizes self-reliance in high-level science and technology as its paramount national priority. If Trump relaxes semiconductor export controls to lock in a rare earth deal that is itself only temporarily binding, the United States risks trading a permanent strategic advantage for a revocable promise. The NVIDIA thread encapsulates the single most financially consequential variable heading into May 14th. It ties your investments, America's long-term tech leadership, and the cost of every device you own directly to negotiations in Beijing. During the October 2025 summit, Trump told reporters aboard Air Force One that discussions on NVIDIA chip exports were primarily between China and NVIDIA, with the U.S. acting as the arbitrator. Analysts interpreted this as a signal that advanced semiconductor export restrictions could be loosened. On January 14, 2026, the Trump administration imposed a 25% tariff on semiconductor imports, including NVIDIA's H200 AI processors produced in Taiwan, while simultaneously revising Commerce Department licensing policies to allow H200 sales to approved commercial customers in China on a case-by-case basis. NVIDIA publicly welcomed the decision. Jensen Huang had been advocating for easing restrictions. The commercial rationale is straightforward. China represents a massive potential market for NVIDIA's hardware. The strategic calculus is equally stark. Advanced AI chips are central to technological competition between the United States and China for the next 30 years. Allowing China access to H200 class processing capability is not merely a trade matter. It constitutes a strategic technology transfer. Beijing will press vigorously on May 14th to make this transfer permanent and expand it to Blackwell class chips, which were explicitly excluded from prior Bususan discussions. The financial reality directly affecting every American investor is stark. The U.S. trade deficit with China stood at $295 billion in 2024. This deficit is structural, shaped not by tariff levels, but by global manufacturing distribution and the deep embedding of American supply chains within Chinese production infrastructure. Apple manufactures over 90% of its iPhones in China, while U.S. retailers from Walmart to Target source the majority of their consumer goods from Chinese factories. The tariffs that Trump imposed, then paused, adjusted, and renegotiated repeatedly have not fundamentally shifted the geography of global supply chains. What they have done is introduce a persistent layer of cost uncertainty that U.S. businesses have absorbed in two ways: passing it to consumers, fueling inflation, or taking the hit themselves, which depresses corporate earnings. Both scenarios affect American households: higher prices at checkout or lower returns in retirement accounts. While the trade war continues, there is no neutral middle ground. This is the dividing line between a genuine deal and a rolling truce, and it matters deeply for your financial well-being. Former U.S. Ambassador to China Nicholas Burns described the Bususan Agreement as an uneasy pause in a trade war that is far from resolved. Piper Sandler analyst Andy Lear told clients plainly that Beijing had made identical promises on soybeans and fentanyl during Trump's first term and did not fully deliver. His conclusion was clear. It is doubtful that Trump gained any structural concessions in return for lowering tariffs. Brookings Institution analysts examining 4 separate U.S.-China agreements negotiated in Geneva, London, Madrid, and Bususan within a single year found that each accord contained enough ambiguity to allow both sides to claim public victories while maneuvering privately. They describe the cumulative outcome as more commotion than progress. This pattern establishes the baseline against which the May 14th Beijing summit must be judged. Xi Jinping has scheduled the entire arc of 2026 with precision. Trump visits Beijing in May. She could potentially attend the G20 in the U.S. in December. Beijing has framed a timeline that maximizes pressure on Washington at every stage, while controlling the optics and staging of interactions. This is a strategic choreography that directly affects every American watching their savings, employment prospects, and the technology sector. China's 15th five-year plan, finalized just before the Bususan meeting, sets self-reliance in advanced science and technology as the explicit top priority from 2026 through 2030. Beijing is not negotiating to deepen dependence on American technology. It is buying time to create domestic alternatives to NVIDIA chips, time to develop indigenous rare earth processing capabilities, reducing vulnerability to U.S. counterpressure, time to secure overseas economic interests. While Washington is preoccupied with the Iran conflict, Brookings scholar Patricia Kim made the point precisely. Both the United States and China control chokeholds over critical global economic sectors, and neither side is willing to yield them. Atlantic Council's senior fellow Melanie Hart noted that there is no evidence the U.S. possesses the same strategic clarity that China applies to these negotiations. Beijing knows exactly what it intends to achieve on May 14th and has been planning for months. The question is whether Washington has prepared at an equivalent level. For Americans, the implications for money are immediate and concrete. 3 direct financial consequences hinge on what unfolds in Beijing. First, rare earth supply chain risk remains the most urgent. China's general licenses for gallium, germanium, antimony, and graphite exports to the U.S. are revocable at any time. Every American company in defense, semiconductors, electric vehicles, and clean energy operates on a foundation Beijing can destabilize within 24 hours of a policy reversal. Domestic processing capacity is in development, as Commerce Secretary Howard Lutnick has initiated, but scaling it will take years. This vulnerability is structural and permanent, regardless of any summit outcome. Second, if Beijing secures meaningful access to NVIDIA chips as part of the agreement, stock markets may initially respond favorably for NVIDIA and U.S. technology broadly. But the medium-term effect, accelerated Chinese AI capability due to American hardware, carries national security and economic competitiveness consequences that markets will not price correctly in the short term. The strategic cost will accrue over years, not days. Third, Decrees 834 and 835 enacted in April 2026 remain fully in force, independent of any diplomatic statements from May 14th. Every U.S. multinational operating in China continues to navigate a compliance trap created by conflicting U.S. law and Chinese national security regulations. This legal tension cannot be resolved by a presidential handshake. It demands detailed regulatory negotiations beyond the scope of summit optics. American companies in China, along with the workers, shareholders, and pension funds tied to them, live in this legal gray zone without a clear timeline for resolution. The May 14th Beijing summit is far from ceremonial. It is not theater. The financial stakes are real, measurable, and already embedded in supply chains, investment portfolios, and the technological infrastructure underpinning the American economy. A public handshake does not alter the fine print. That fine print, Decree 834, Decree 835, revocable rare earth licenses, and semiconductor access exchanged for strategic concessions, is where your money will either remain secure or be quietly shifted away from the American side of the table. If this analysis has provided insights overlooked by mainstream financial coverage, share it with someone who believes the Beijing summit is merely diplomatic theater. It is not. This is the most consequential financial negotiation of 2026, and understanding it before May 14th is essential.